Hi, I'm Emmett Cosgrove, Vice President and Wealth Advisor at Mercer Wealth Management. If you've turned on the news at all recently, you've probably heard nothing but negative or pessimistic news stories. The financial news is no different. When we have it on in the office, we're often hearing conversations about the impending recession or a debate over whether or not we're already in a recession. And as they're having these conversations, they're bringing up this term called yield curve inversion. So today I want to go into what exactly does the term yield curve inversion mean, how should we think about it, and how does it impact us? So to start, let's think about what is a yield curve. A yield curve is a point on a graph that measures the yield, or in this case, the interest rates of a bond measured over time, or the maturity of that bond. In this case, generally that yield curve can be shaped in three different ways. You can have a normal yield curve, which is an upward slope, an inverted yield curve, which is a downward slope, or a flat yield curve. So an upward sloping line or upward curve generally means that it's indicating a period of economic expansion. This is because investors believe they will receive a higher interest or rate of return for their investment in those bonds over the long term. The downward sloping or inverted curve is the opposite of that. So investors believe that over time they will receive less interest or return on their investment in those bonds. So it could mean we're heading into a period of an economic contraction. The flat curve is probably the least likely scenario because it's just telling you that interest rates or investor expectation are to remain flat over time. And this is not likely because the expectation is constantly changing. Economists are constantly debating which two bonds they should be using when measuring this yield curve inversion. For the purpose of this video, we're going to use the 10-year US Treasury compared to the 2-year US Treasury. Interestingly, dating back to the 1960s, every single time the interest or yield on the US 2-year Treasury rises above that of the 10-year Treasury, it ends up being 100% a recessionary indicator. Let's look at a few other times throughout history where this has come true. Let's take a look at this 10 to 2-year Treasury yield spread. As you can see, in January 1989, sure enough, the 10 to 2-year spread dipped below zero, which represents that yield curve conversion. If you fast forward a bit, you can see the gray recessionary indicator, which represents the Gulf War recession that happened in 1990. Fast forward a bit to February of 2000, we have another yield curve inversion. Well, if you remember the late 1990s leading up to 2000, we had an explosion of the Internet of Things. Well, this led to the dot-com bubble. But sure enough, as we said, 100% a recessionary indicator, that February of 2000 dip led to a recession. Now we'll move to February 2006. Everyone can remember this is just before the global financial crisis. There was a great housing boom throughout the early and mid-2000s, which led to a housing bubble. Well, this February 2006 yield curve inversion, sure enough, led to, in late 2007 and throughout 2008, the Great Recession. Now, our next recession was in March of 2020, sort of a flash recession as a result of the coronavirus pandemic. Now, interestingly enough, just several months before, in August of 2019, there was another yield curve inversion, but it's tough to draw parallels that yield curve inversion could have led to the coronavirus pandemic, but sure enough, there's another instance. Most recently, on April 1st of 2022, we had a yield curve inversion from the 10 and the 2-year, which was a slight dip. And then fast forward to July of 2022, and since that time, the 10 and 2-year curve has been completely inverted and remained that way. Well, that covers our conversation today on the inverted yield curve. As promised, we want to keep these episodes short, to the point, and of course, very frank. If you liked our content today, please be sure to like and subscribe and share with friends and family. And be sure to join us again next week for another episode of Frankly with Mercer Wealth Management.